In the world of technology, some companies are household names, instantly recognized by their logos and products. We see their advertisements everywhere, and their devices fill our homes and offices. But behind the scenes, there are other companies, less visible, yet absolutely essential, that quietly power the digital world. These are the unsung heroes, providing the backbone for everything from cloud computing to streaming your favorite shows. Broadcom Inc. is one of those unseen giants. Its chips and software are embedded in countless devices, enabling your phone's Wi-Fi, connecting laptops, and running the world's largest data centers. Whether you're sending an email or watching a movie online, chances are Broadcom technology is working in the background. The company's strategy, led by CEO Hock, is to dominate niche, mission-critical markets, areas where reliability and performance are non-negotiable. This focus allows Broadcom to command strong pricing power and deliver impressive profits year after year. Recently, Broadcom made a bold move into software with its acquisition of VMware. This strategic leap aims to blend Broadcom's hardware expertise with VMware's high-margin, recurring software revenue, creating a powerful combination that could reshape the industry. But the tech landscape is shifting at breakneck speed, driven by the explosive growth of artificial intelligence. AI is not just a buzzword, it's transforming how businesses operate, how data is processed, and how value is created in the digital age. AI's rise has turned semiconductors into the new gold rush. Broadcom's deep expertise in networking and custom chip design puts it at the very center of this transformation, making it a key player in the race to power the next generation of intelligent systems. On December 12, 2025, Broadcom reported record earnings and a massive AI order backlog. By all traditional measures, it was a stellar performance, one that would make any company proud and investors optimistic. Yet, in a surprising twist, the market responded with a sharp sell-off, sending Broadcom's stock tumbling in its biggest drop in a year. Even the best results can be overshadowed by the weight of expectations. Why? Because in the frenzy of the AI boom, even incredible results can fall short of sky-high expectations. Investors are always looking for the next big leap, and sometimes reality can't keep up with the hype. This is the story of a company delivering excellence at every turn, and a market that, in the age of AI, demands even more. Broadcom's journey is a testament to the challenges and triumphs of leading in a world where innovation never sleeps. The AI revolution has created a voracious appetite for specialized chips, AI accelerators that power everything from chatbots to scientific breakthroughs. Nvidia leads the pack, but its dominance and high prices have tech giants searching for alternatives. Broadcom's approach is different. It builds custom chips, ASICs, for a handful of massive clients, enabling them to design their own AI hardware. Think of Nvidia as selling powerful tractors, while Broadcom engineers custom harvesters for the world's largest farms. Companies like Google and Meta turn to Broadcom for the expertise and scale to realize their custom silicon ambitions. Broadcom's real strength? Its best-in-class networking technology, essential for connecting thousands of AI chips into supercomputers. In the race to build the future of AI, Broadcom is the indispensable architect behind the scenes. December 11, 2025. Anticipation was high as Broadcom prepared to release its fourth-quarter earnings. The company delivered record revenue, soaring profits, and a 10% dividend hike. CEO Hock announced that AI-related semiconductor revenue would double, backed by concrete orders. By all accounts, it was a triumphant moment. But the next morning, the stock plunged 12%, its biggest drop in 10 months. Why the disconnect? Investors had already priced in perfection. The market wasn't just looking for great numbers, it wanted results that shattered even the wildest expectations. When Broadcom delivered merely excellent results and a realistic forecast, it wasn't enough. In the AI gold rush, even spectacular success can feel like a letdown if it doesn't exceed the hype. Sometimes reality just can't keep up with the narrative. One headline from the earnings call stood out above the rest. A staggering $73 billion backlog in AI product orders, already locked in for the next 18 months. This isn't just a number, it's a testament to the overwhelming demand for AI infrastructure and the trust customers are placing in Broadcom's technology. The backlog represents contracts signed, money committed, and a future pipeline that most companies could only dream of. For most companies, News like this would be cause for celebration, a guaranteed stream of future revenue, a sign of market dominance, and a reason for executives to pop champagne. It's the kind of financial security that can drive long-term planning and innovation. But for investors swept up in the current wave of AI hype, the timeline felt frustratingly slow. The excitement around artificial intelligence has created sky-high expectations, and many were hoping for immediate results. The market wanted instant gratification, not a promise that would play out over 6 quarters. Investors, always hungry for the next big thing, were left wondering if the payoff would come soon enough to justify the hype. Hock's transparency about the delivery schedule was meant to reassure, but it also served as a reminder. Building the backbone of AI is a massive, complex, and time-consuming undertaking. There are no shortcuts when it comes to creating the infrastructure that will power the next generation of technology. Manufacturing advanced chips, integrating them into powerful servers, and deploying them at scale across the globe isn't plug-and-play. Each step requires precision, expertise, and time. Lots of it. The $73 billion backlog proves Broadcom's critical role in the AI revolution, but its extended timeline was a reality check for those expecting overnight transformation. It's a reminder that real progress, especially at this scale, takes patience. In a market obsessed with the next quarter's results, even massive future orders can feel like a letdown if they don't translate into immediate gains. The pressure for short-term performance often overshadows long-term potential. The fire hose of AI revenue wasn't about to be turned on full blast, at least not yet. The process is more of a steady build than a sudden flood, requiring patience from everyone involved. For some, that was a bucket of cold water, a sobering reminder that in the world of technology, even the biggest promises can take time to deliver. Beyond the backlog, another concern emerged: profit margins. Broadcom warned that its gross margin would decline by about 1 percentage point in the next quarter. The reason? More of its AI revenue now comes from selling complete systems, not just high-margin chips. System-level sales generate more revenue, but lower profitability, pulling down the company's average margin. For investors who prize Broadcom's history of high margins, this was a red flag. The market worried, would chasing massive AI revenue force Broadcom to sacrifice its hallmark profitability? With rising costs everywhere, any sign of margin compression is magnified. Winning in AI might mean trading some juicy profits for growth, a trade-off the market wasn't ready to accept. On the earnings call, Hock declined to give a specific AI revenue forecast for 2026, calling it a moving target. He explained that the pace of change in AI is so rapid and the variables so numerous that any concrete prediction would be little more than a guess. For a company of Broadcom's scale, making such a public commitment could have far-reaching consequences. This ambiguity spooked investors, who crave certainty and numbers to plug into their models. Without clear guidance, analysts are left in the dark, forced to make their own assumptions about Broadcom's future growth. From Broadcom's perspective, the AI landscape is evolving too quickly for long-term predictions. New technologies, shifting customer needs, and competitive pressures make it nearly impossible to forecast with confidence. Committing to a number now would be risky, too low, and the market is disappointed, too high, and the company risks missing targets. Either way, the consequences could be severe, impacting both reputation and stock price. Tan's caution is logical, but the market is impatient. Investors want clarity, and they want it now, even if the reality is more complicated. Investors want bold, long-term roadmaps, not pragmatic restraint. They look for visionary statements that can justify high valuations and ambitious expectations. The absence of a 2026 target made it harder to justify Broadcom's lofty valuation. Without a clear number, the story becomes less compelling for those betting on future growth. In a world of hype, realism can feel like a lack of confidence. But sometimes, restraint is a sign of wisdom, not weakness. The ghost of 2026 haunted the call, marking the boundary between certainty and speculation. For now, Broadcom chooses to stay on the cautious side of that line, even if it means disappointing those hungry for bold predictions. Beneath the headlines, Broadcom's recent wins show its strategic importance in AI. Anthropic, a major AI player, placed $21 billion in orders with Broadcom in just 2 quarters, proof that custom silicon is big business. Google relies on Broadcom to co-design and manufacture its custom TPUs, cementing Broadcom's role in the AI supply chain. OpenAI, creator of ChatGPT, also struck a deal. It will deploy custom accelerators using Broadcom's technology, starting in late 2026. These are massive, multi-year commitments, but the revenue won't hit Broadcom's books for years. For a market focused on the next few quarters, that's a tough sell. The deals confirm Broadcom's long-term relevance, but highlight the lag between winning business and booking profits. The path from order to income is long, and investors are impatient. Broadcom's $73 billion AI backlog is concentrated among just 5 customers. This deep partnership model brings efficiency and scale, but also risk. If any of these tech giants change strategy, delay spending, or face trouble, Broadcom's revenue could take a hit. The company's fortunes are tied not just to AI's growth, but to the success of a handful of hyperscalers. This lack of diversification makes future earnings more volatile and harder to predict. The tech industry is fickle. Today's partner can be tomorrow's competitor. The market's reaction on December 12th reflected this risk, balancing the rewards of big contracts against the dangers of concentration. Too many eggs in a few very large baskets can make even a giant feel vulnerable. Broadcom's dramatic stock drop despite stellar results is a lesson in market psychology. The company is executing brilliantly, profitable, essential, and deeply embedded in the AI revolution. But the market's expectations, fueled by AI hype, are nearly impossible to satisfy. When Broadcom delivered nuance, growth, but also margin pressure and realistic forecasts, it clashed with the narrative of endless, exponential gains. The stock was punished not for failure, but for honesty. For long-term investors, the pullback may be a healthy reset, a chance to own a world-class company at a better price. The AI build-out is a multi-year, multi-trillion-dollar journey, and Broadcom is at its heart. The road will be volatile, but the destination, powering the future of intelligence, is clear.